China's crash nears. I'm Steve Van Metre, and this one missed reason is about to slam China's economy and global markets far worse than the tariffs ever could. It's coming fast, and you won't believe what everyone's missed. Now let's head over to Bloomberg, where we find out why it's game over, China. As we start with the headline, is U.S. consumer borrowing has unexpectedly declined in a broad pullback. And so you can see that the biggest force in the global economy is not tariffs, it's the U.S. consumer. And when they stop spending, it's going to hammer the Chinese economy, because when you put this in perspective, they're the world's largest exporter, we're the largest importer, meaning they're highly dependent on U.S. consumers to spend and spend big. And right now, U.S. consumers are looking at the economy. They're seeing it slow down. They're seeing the labor market weaken. They're seeing prices that are already high and likely to go higher. They're worried about their job. They're worried about their income. And when that happens, it means they're going to cut spending. And for China, this is the beginning of the end. And total credit fell nearly $810 million after a revised $8.9 billion gain in January. Outstanding credit card and other revolving debt edged up $128 million. Non-revolving debt, such as loans for vehicle purchases, school tuition, that declined $938 million, the first drop in nearly a year. And this is now the first sign that U.S. households are starting to wake up to the reality is that the economy is slowing down and there's going to be a period of pain. Now, maybe things turn around. Maybe that's actually what's going to happen in the near-term future. Maybe there's going to be a whole lot of deals made. Maybe we're going to head into a recession. Now, I want to know from you, weigh in the comments below, do you think we see the U.S. economy turn around as deals are made, or do you think the inevitable of a recession is now here? Because what we're seeing in the credit data is that U.S. consumers are starting to worry. Now, this is important to understand because we're a debt-based economy, and in a debt-based economy, we need people to borrow money to buy things they don't need, and that's the issue here right now. Consumers paying down debt rather than taking on new debt and consumption. And these figures indicate American households were starting to grow more cautious in February about their debt loads. Concerns about higher inflation and personal finances have continued to mount due to President Donald Trump's tariff push. And these were already issues we were facing. We talked about how inflation was cooling off and the trend was actually lower, but now that the tariffs have come on the board, well, it changes the game. They're going to send prices higher. We're hearing this from not only at the manufacturing level, which is telling us that input prices are rising. We're hearing this from C-suite executives across the board saying, look, we don't have a choice here. We're going to have to raise our prices. But this is the issue. Inflation now going up, but it's also about household finances. And we see this in the Conference Board data. We see this from University of Michigan. What are consumers telling us? That their wages, they're not going up. They're fast enough to keep up with inflation. And in some cases, people are worried about losing their job. They're seeing their hours get cut. And they now know with the tariffs, that's likely to get worse. And moreover, an abrupt and sharp plunge to the stock market risks causing the most credit-worthy and high-income borrowers to become even more guarded in their spending and borrowing. And this is a case I made recently on Jeff Snyder's show. If you've been watching Eurodollar University, I said there's one big problem in the economy right now, and that is a lot of the wealth is concentrated in one generation. That's the baby boomers, and their wealth is tied to the upside of the stock market. The higher it goes, the more they spend. When it comes down, their purse strings tighten up and fast. And right now, they're nervous as well because the stocks have been going down. And the fear is they're going to go down even more. But let's talk about what the average household's doing. And that means they're starting to save. Let's take a look at this chart of advanced retail sales. This is inflation adjusted, that shown in blue on a year-over-year rate of change, and gets the personal savings rate. Now let's go back to the mid-1990s when we saw a slowdown in real retail sales here in blue. And what happened at the same time? The economy is slowing down. Now many people thought we were likely headed into a recession, but the economy was clearly slowing down then. And what was the response from U.S. consumers? They increased their savings, as we see the personal savings rate in red head higher. And you can see this relationship over and over. We see it happen in late 1999, real retail sales on the downturn and even enter a contraction as we go into the dot-com bubble. Meanwhile, households saving money as they worry about their finances and they can't afford higher prices from inflation. You see that happen starting in 2005, real retail sales on the downturn. At the same time, consumers have already drawn down their savings, now look to start saving more money. You see it happen around 2010 into 2011, again going into the pandemic starting around 2018. You see it afterwards. Look what happens in 2022. That hit to retail sales had everything to do with consumer saving. Now what we're hearing is they're going to start saving more because they're prioritizing their debt. And so when they stop taking on new debt and they start paying down old debt, it's a warning sign for the economy. And this is something that, again, has nothing to do with tariffs, has everything to do with China's economy, because they're going to tell us that they're ready to fight and they're going to stick with this to the end. And they've got all the tools they can use, particularly devaluing the yuan, as we talked about yesterday. But here's the reality is they can't make the U.S. consumer spend. That's something that is the biggest force in the global economy right now. And stress among lower-income households was already starting to build. Back in January, the share of subprime auto loans that at least 60 days past due climbed to 6.56% in January, the most in data back to 1994. High car prices and elevated borrowing costs are straining budgets. Now, I disagree with that. I don't think high car prices are straining budgets. Now, I do get that elevated debt service costs are a factor here, but what's the real issue that's plaguing the U.S. economy right now? It's that inflation is going up, but wages aren't. People aren't getting more hours. They are getting some pay raises, but in the end of the day, when they get their check and they look at their take-home pay and then they go home and add up all their bills, it's not enough, especially as we continue to see prices headed higher. In the fourth quarter of last year, the share of consumer debt in some stage of delinquency climbed to almost a 5-year high. And this is, again, something we see that is a sign that households are running out of money and that inflation is getting too high. But look, if you need extra money, turn to the markets, because even though they're melting down, we put a trade on before all of this happened in Brazilian equities, and in less than 2 weeks, our subscribers nabbed a clean 7% gain. But now with markets down, machines are selling and selling hard, setting up a massive opportunity for you to make money in the markets. If you want to know how, stay tuned to the end of the show. Hit the links in the description, grab the coupon code for a free 30-day free trial, because when this turns around, it's going to make a lot of people a lot of money, and you can be one of them. Now let's turn to this chart as we look at the delinquency rate on credit card loans, shown in red, against total income for production and non-supervisory employees. That's shown in blue on a year-over-year rate of change, and it makes perfect sense of why the delinquency rate is going up. See, the excuse is, well, it's high car prices, or it has something to do with debt service costs. No, in the end of the day, people can afford expensive cars. They can afford debt service costs as long as their income is rising, and that's the key point here. And we could see that happen back in the mid-1990s. The reason the economy was slowing down, the reason we see the personal savings rate go up and retail sales go down, it's because income growth was headed lower. And look what the immediate response was. The delinquency rate rises. Again, makes perfect sense. People can't afford to pay on their debt because their paycheck is not expanding at a rate that it needs to afford higher prices and to service all their debt. You see it happen going into the dot-com bubble, a deceleration in incomes, a rise in delinquencies, right into the recession. Happens again going into the global financial crisis. Again, incomes decelerate. We know that energy prices sent consumer price index up. At the same time, consumers cash strapped, they enter delinquency, and you could see the recipe for recessions and financial crises from the consumer perspective. It's when their wages go down, inflation goes up, it means the delinquency rate rises, and this becomes a major risk to the banks. You know, you think back to after the election, a lot of people said, hey, you got to go be bullish on the banks because this is a really big win for them. And I'm like, wait a minute, if we go into a recession, it's going to be a major problem for the banks because consumers are highly indebted here. The economy is already slowing, and now you can see the risks are starting to mount. And again, we come back to why China can't win this in the end. Well, it has everything to do with the U.S. consumer, who's telling us right now they're broke. Now let's overlay real retail sales in blue against the delinquency rate, because I want you to understand that in a debt-based economy, people borrow money they don't have to buy things they don't need. But the issue is when you start to go into delinquency, well, the risk is the banks aren't going to extend further credit. And if you don't have more credit coming to the system, well, it impacts the sales market, and then that turnaround impacts the labor market. Let's take a look at what happens going back to, again, to 1994. The delinquency rate is rising. Consumers are unable to access more credit. That means their spending goes down. You see it happen going in the dot-com bubble. Once again, going into the global financial crisis, and it's happened again. You know, people said that, hey, there's going to be a big upshoot in retail sales now that the election's over. We said not going to happen. Then it did happen because of the tariffs and everyone front running them. But now what are we seeing? In February, consumers saying, look, we're tapped out. We don't want to borrow more money. In fact, we want to pay down the debt we have. And next thing you know, you're going to see the data from the personal savings rate rate suggests the households are saving more money because we've seen, again, in all the survey data, they're worried about their jobs and their finances. Monday's consumer credit report showed still elevated prices and high borrowing costs are challenging household finances. The average rate on credit card accounts with assessed interest was a whopping 21.91% in February, still close to the highest in Fed data going back to 1995. And what have we heard from the Fed? Fed Chair Powell recently said, look, we're in a wait and see mode. We don't know what's going to happen, so we're going to do nothing. Meanwhile, the average American household is facing massive interest on their credit card bills. They need some sort of relief, and the problem is they know prices are going up. They know demand is coming down. They know it's going to hit the labor market, and next thing you know, we could be on the cusp of an all-out financial crisis. But I want to know what you think. Do you think President Trump turns this around and fast, or do you think it's too late and we're already plunging down? Weigh in the comments. I want to hear from you, because let's talk about how this impacts, of course, inflation. Here we have total incomes in blue now overlaid against the consumer price index in red. What do we see? Prices rising. You see income growth slowing right into a recession. You see it happen going into the dot-com bubble, into the global financial crisis. And now what are we facing due to the tariffs? We know prices likely to go higher. Income growth for workers is stalling out because employers don't benefit from tariffs. This is not money they can pass on to their workers. In fact, what's even more interesting, employers are starting to complain that one of their biggest issues is how much they have to pay their workers. As U.S. small business optimism now declined by the most since mid-2022. The share of owners expecting better business conditions in the next 6 months plunged 16 percentage points, the steepest slide since December of 2020, and the third straight decline. The percentage of firms anticipating higher inflation-adjusted sales volume dropped 11 points from February, the most since the start of last year. So not only do we see a change in consumer credit in February, but look what businesses are saying. Look, we're not expecting more demand here. In fact, we think demand is going to go down. This is exactly what I said was likely to happen. Now, what's more interesting is they loaded up on inventory, and this is going to be a problem because at some point, if they can't move it, they've got to mark it down. Let's take a look at how sentiment has wavered on tariff concerns. Remember, after the election, small business sentiment surged straight up. We said, don't buy that. It's going to flip over. And sure enough, now it's plunging back down as businesses are waking up to the reality. It's all about U.S. consumers. And the problem is they're completely tapped out. Small business owners have scaled back expectations on sales growth as they better understand how these rearrangements might impact them. Well, it's not about how it's impacting them, it's how it impacts their customers. And for their customers, it means prices go up, incomes go down, demand goes down, sales go down, and next thing you know, it hits the labor market in a big way. And let's talk about how this backfeeds up through the supply chain. As you see demand at the retail level fall, inventories are already now too high. What it means is the new order book is going to fall as we now overlay real retail sales still in blue against manufacturers' new orders of durable goods in red. And I want you to see the relationship here. As retail sales go down, well, that means, of course, inventory levels aren't falling fast enough. And that means, of course, you don't need as many new orders on the books. And sure enough, what do you see on the new orders? That decelerates. You see it happening going into the dot-com bubble. Again, the global financial crisis, both decelerating. You see it when we almost had a double-dip recession in 2011 going into 2012. You see it happening going into the pandemic. And now you're seeing it happen again as retail sales go down. It means, of course, retailers ordering less. That means passing through to the supply chain at the wholesale level and all the way up to the manufacturing level. And now the risk comes that they're going to start laying off. The group's gauge of uncertainty slipped 8 points to 96 a month after registering its second highest reading on record, suggesting small businesses aren't uncertain as they were, but still fairly uncertain. And tariffs announced by President Donald Trump last week were larger than expected, leading to a sharp correction in financial markets. Economists have become more downbeat about the economy's prospects, with many raising the odds of a recession. They also see a greater chance of higher inflation. So the problem is, as people start to believe a recession is coming, they spend like a recession is coming. And that's exactly what we're starting to see in the data as we now overlay the unemployment rate against real retail sales, still in blue, against manufacturers' new orders of durable goods, that's still in red. You can see those slowdowns. Well, that impacts the labor market as demand for new orders and sales go down. Well, demand for workers goes down as well. That's why you see the unemployment rate rising right into the dot-com bubble, as it does once again going to the global financial crisis. And now the risk is it's going to happen again. And we're seeing this all happen in what appears to to be slow motion from an economic perspective, rather high speed when we take a look at the equity markets. Meanwhile, hiring and costs continue to pose challenges for small companies. 19% cited labor quality as their single most important problem, meaning they can't find experienced workers. And that was followed closely by taxes, which are cited by 18%, the highest share since November of 2021. But here's the big one. In March, 40% of small business owners reported job openings they couldn't fill, up 2 points from February. However, the share of owners planning to create new jobs in the next 3 months declined 3 points to an almost one-year low, suggesting a more cautious approach to expansion and staffing. So this is an issue now. Let's take a look at this chart as we talk about how workers need higher pay gains. They're not likely to see it because when you take a look at the job openings and labor turnover survey, that's shown in blue, against average hourly earnings of production and non-supervisory employees in red, you see a very clear relationship. As employers pull job openings, well, it's game over for pay raises. Yes, you still get them, but they're going to be much smaller than they have been in the past. And you can see the trend now is likely to continue. A small business owner say, look, we don't need that many workers. And that means those that we do keep, or you're not going to get the pay gains you need. Meanwhile, Bessent sees good deals as potential as the U.S. works through its priority list. But if they come to the table with solid proposals, I think we can end up with some good deals. And part of the calculus on that may be that some part of the tariffs stay on. So if you want to know why small businesses are uncertain, why consumers are panicking here and cutting their spending, why the stock market's reacting the way it is because nobody knows how this is going to work out. Nobody knows if the tariffs are going to go away completely, if tariffs are going to stay. Nobody has a clue, and that uncertainty causes people to cut spending in a big way, which is why we're saying for China's economy, you can see it's total game over here across the board. But meanwhile, China says it has ample policy tools to offset external impacts. And while that is true, one thing it can't offset is the U.S. consumer. Chinese Premier Li says his country has ample policy tools to, quote, fully offset any negative external impact, and reiterated his optimism about growth of the world's second largest economy in 2025, despite the latest tariff threat from President Donald Trump. And yes, that is possible. You can devalue the yuan and offset it. But once again, they can't put money in U.S. consumers' pockets. They can't make delinquencies go down. They can't give them pay raises or more hours. They can't do any of those things. So when you start to put this in perspective, the reason it's game over for China and China's economy right now has everything to the U.S. consumer, who is unfortunately saying, we're broke. But despite you see households running out of money, doesn't mean you can't make money in the markets. We talked about this trade on Brazilian equities, and right now machine positioning is massively short across the board. And when this happens, it creates huge opportunities, because when the market eventually turns around, that means those machines are going to have to cover their short positions and put a huge tailwind of buying underneath. This is something that you can take advantage of, because each and every day we look at how machines are positioned across the broad equity, bond, currency, commodity markets. But what a lot of people don't know is they trade short-term windows, but we've taken all the data and made a historical overlay to see how machines should be positioned versus how they are. So when we see machines going to buy, well, it tells us that our subscribers need to get in first. And all that data is integrated right into our hot list on our report. That historical data is modeled there, but you still get all the current positioning. And because of our historical overlay, what it tells us is we can actually predict with reasonable accuracy when the machines are going to buy and they can sell, giving you the edge. So not only do you get the daily report and all the tradable signals, I review all the trades and give you my opinions on which ones you could take. I give you risk control levels. I track all the open trades and returns. I give you a weekly update. I disclose how I'm trading my own book. And even more importantly, you don't even have to pay a dime to start. That's right. You get your first 30 days on me. That's because we're so confident you can make money trading the reports. Grab the links in the description below. Use the coupon codes for your 30-day free trial. And with that, I'm Steve Van Metre. Thanks for watching. Thanks for being fans. Bye now.